Well, maybe as my slides are being prepared, I'll talk a little bit about the macroeconomy in the Philippines. The Philippines has been one of the star performers in Asia as well as around the world recently, and it's really because we had a very good president who had a good reputation and who was able to clamp down on corruption. And because of this, there's a lot of foreign direct investment that has come inside the Philippines. And it has really increased our profile. Unfortunately, next year would be an election year, so we are a bit worried that that environment may change. Although there are some candidates, some frontliners that we believe that could uphold the economic growth as well as the investment environment that we have. Okay, thank you. Okay, so previously we were known as the sick man of Asia, but during the past 3 years, we've exceeded a growth rate of more than 6% annually. So we could say that we are now removing that image, and we are working towards maintaining it moving forward. So we've already put together a more transparent government, but there are still some problems regarding some corruption, either on a local or regional basis. One of the drivers that we have is a growing population. And actually, I'll talk about it later, that we're actually entering into a demographic sweet spot wherein a big portion of our population is maturing and is entering into the workforce and would provide a growing base for consumption in the Philippines. Okay, so as I mentioned earlier, our economy is trending upwards. Last time I was here, the average of President Aquino was higher. Unfortunately, for the first part of 2015, the economic growth fell to around 5%, so it averaged at 5.3 for the first half. And it was mainly because of his decision to pull back on spending, especially on public construction. And of course, there was a decline in exports because of what's going on in Europe, as well as the effects of the El Nino phenomenon, which has also dampened growth in the agricultural sector. But the growth rate, which is anticipated to be around the high 6% or low 7% for this year, it has dropped to around 5.3%. So we're still hopeful that we can catch up during the second half, but it would be a bit challenging. So because of the economic growth that we've had during the past few years, HSBC actually recognized the Philippines that it will grow to become the 16th largest economy by 2050. And it's really because of the growing population that will drive this. Bloomberg also mentioned that the Philippines might become the second largest or the second fastest growing economy for 2015, following China. But with this kind of growth rate, I don't think that we will emerge as such, but we're still hoping that we will. Okay, so, but despite of this, and despite of whoever sits in the presidency next year, there's still some fundamental drivers that will continue to propel the Philippine economy. So number one would be the Ofw remittances. About a tenth of our population actually lives abroad, working and then sending home much needed dollars to their families. And this drives consumption. Last year, we hit about $24.3 billion, growing at about 6% each year. And it's equivalent to about 9% of our economy. And 30% of this is actually used for housing-related needs, such as housing purchases or rentals. So it drives the residential sector quite well. And also, OFWs are becoming more investment savvy. So if you compare it, for example, 10 years ago, they're just buying consumer goods like stereos, TVs, and so forth. New clothes for their kids. But now they're actually investing that money into mutual funds and real estate. So they're becoming more financially savvy. Okay, another growth driver would be the BPO industry, or the business process outsourcing industry. This is actually driving the office sector, not just in Metro Manila, but elsewhere in the Philippines. But for example, 10 years ago or 11 years ago, there were only about 100,500 employees in this sector and generating about 1.5 billion US dollars. It's now grown to about 1 million full-time employees and generating about $18 billion. The IT and BPO Association of the Philippines thinks that this will grow to about $48 billion by 2020. So enormous growth in this sector. We've already displaced India as a top location for voice-related services. In our non-voice services, which are higher value, this involves accounting, finance, risk management, engineering, animation. This is a growing component. It's now grown to about 40% of all BPO-related services. So it has been expanding. And how does this drive real estate? So apart from the demand for office space, it also drives retail, since the BPO workers have a higher income level and they usually consume. They're usually the yuppies are from about 20 to 30 years of age. So they consume a lot. They buy phones, buy new clothes, and so forth. And also, while they might not be able to afford condos yet, they're actually the renters for the condos. So this is an emerging trend. The real estate, well, not just real estate, but the general economy has been supported by low interest rates. So right now it ranges between about 4.5 to close to 7%. Mortgages in the Philippines are about 6% if you take out a loan from a bank. So I know that this is quite high compared to what you could get a mortgage here in Singapore would be, but it just reflects the risk that the banks would have in the Philippines. The Central Bank of the Philippines probably will not increase interest rates despite a movement since the U.S. Federal Reserve has been saying that they will increase interest rates. I don't see that the central bank will move it quickly. And it's really because of the inflation rate. As of the second quarter, it fell to about 1.7%. In July, this fell to less than 1%, about 0.8%. So I think that the inflation rate environment will continue to be low. Okay, so another driver that I foresee moving forward is that we have a very young population. And actually the percentage of our total population versus the working population will continue to increase. So from about 54 million, or about 53% in total in 2015, this will grow to about 58% of the total in 2035. And this will drive consumption as well as demand for housing. And yeah, a lot of pundits would say that we've entered the demographic sweet spot wherein a big portion of our population has now entered into the workforce, and we'll start seeing the effects soon. Okay, now I'll talk about investing in real estate. So I'll start with the residential market. I was here, Metro Manila was actually but so far Jakarta has surpassed us. I guess there were some movements in terms of their currency. That's why this has increased to about 8.9%. I also did not have Cebu last time, but now we could show that it's actually performing quite well with an 8.5% gross rental yield. So this is before any operating expenses or taxes are deducted. So Manila performs at around 7.4%. So it's still part of the top 3 and would provide a lot of opportunities. So if you compare it, for example, to Singapore, which only provides a 2.5% rental yield, or gross rental yield, then it looks very attractive. And this is as of the end of 2014. Manila is a third least expensive in terms of property investment or residential property investment, averaging at around 3,855 Singapore dollars. So if you take a look at the rental yield and then compare it to the capital values, of course, there's a lot of opportunity here. So capital values in Singapore is about 5 times of that in Metro Manila. Okay, location-wise, the CBDs still outperform the rest of the city. So Makati is the financial district or the traditional CBD. It's a dominant CBD. It's about 6.9%. Rock is just outside of the Makati CBD. It's considered a haven for the expats, very popular with the expat community because of the environment that they have there. It's basically a residential enclave that's close to the financial district. Fort Bonifacio is emerging new CBD. So later on I'll describe it further so you have a reference point. The gross rents there are around the 7.01%. Ortigas used to be the secondary CBD. The rental yield would be lower, about the 6.8%. And then Eastwood also, this is in Quezon City, an emerging CBD, delivering a gross rental yield of 7.1%. So very attractive yields for these different business districts. Okay, and another indicator would be the growing land values. We've actually surpassed, as of sometime last year, the levels or the price levels that we've had before the Asian financial crisis in 1997. But if you adjust it for inflation, it's still quite low compared to the levels back in 1997. So there is still some room, we think, for it to continue to increase. And then for lease rates, from what we found, based on the statistics, there has been an annual growth of close to 7% between 2003 and 2015. So we continue to see that, although we can't say that these would be inflationary or price increases are going out of control because they have been quite stable, moving upwards of between 6 to 8% each year. Okay, so for capital values, also growing at around 7.5% each year. So quite stable in terms of growth. Okay, so where do you invest if you plan to go into the Philippines? Okay, so as I mentioned earlier, Makati is the dominant CBD since the 1960s. It was built by the Zobel de Ayala family. So this is basically their development. And the growth has spread into the fringes. So apart from Ayala Center, or what is commonly known as Makati CBD, you would have Rockwell, which I mentioned earlier, which is very popular with the expat community. And then an emerging development would be Century City. So currently this has some of the prime developments. One of the most expensive would be the Century Spire and the Trump Tower. So we have a Trump development in that area already. Okay, so just wanted to talk about some projects. So this is a project by Ayala Land, one of the leading developers in the Philippines. So it's called Garden Towers. The average unit size would be 117. So this would become considered a luxury project, and it's selling at around 22 million pesos, or roughly about 665,000 Singapore dollars. So this is on the high end. A little more affordable would be 3 Central by Megaworld, another top developer, selling at around close to 200,000 Singapore dollars. With an average unit size of 52. So usually It's easier to rent out these smaller unit types to your yuppies, but the problem is moving forward, a lot of the new developments are actually focusing on that type, so the studios and the one bedrooms. The opportunities moving forward would be the bigger unit types, which could be marketed towards the expats. And they're really running out, especially in the Fort Bonifacio area. Okay, so Shangri-La, through Shang Properties, she has several developments in Makati. So they have two. This is one of their more expensive ones, selling at around 8 million pesos or about $243, with an average size of about 62 square meters. So that's located inside the Makati CBD, but just across the street from where the Makati CBD is, so this is the border of Makati CBD. This is called The Rise by Shang Properties. It's more affordable and it attracts the yuppies. It's selling at around $125,000 with an average size of about 38 square meters. So it's just at the fringe, and being a development of Shangri-La really attracts a lot of buyers, and it's just a stone's throw away from the CBD. Okay, as I mentioned earlier, this is the Century Spire, one of the most expensive properties in Manila, selling at close to $500,000. Average size of 50. This was designed by Daniel Libeskind, and basically the common areas are fitted with Armani Casa. That's the strategy of Century Properties. They usually tie up with a brand, like a luxury brand or a popular architect. They actually have a project where Paris Hilton designed the beach club or the facilities. Okay, the Stratford Residences is right beside the Century Spire development, or just Century City. So it's actually selling at a much more affordable rate, around $290,000, with an average size of 48, so it's much more spacious. So there is an opportunity to invest here in this property. Okay, as I mentioned, Rockwell is quite popular. This is the Proscenium development designed by Carlos Ott, who designed the Burj Al Arab in Dubai. So this is one of the more expensive towers, the Sakura Tower, selling at close to $1 million, Singapore dollars. So this has 5 towers, one of which is the Sakura. And then you have the Lincoln, which is more affordable at 382,000 or 12.6 million pesos, with an overall average size of 72 square meters. Okay, now we go into the Fort Bonifacio area. The fort has been very popular because it's a newer CBD. It used to be a military base. It was converted back in the 90s and is now being developed by the Ayala Land and Greenfield joint venture. So it's quite popular because it's better planned compared to Makati. So you have Bonifacio Global City, which is this is the one being developed by Ayala, and then you have Uptown Bonifacio and McKinley Hill, which is being developed by Megaworld. Okay, so this is one of the more expensive ones that we have in Fort Bonifacio, also by Ayala Land, selling at close to $600,000 or 20 million pesos. Average size of 145 square meters. So only 411 units in this development. Very close to the Bonifacio High Street retail strip. Okay, so this is a new development, or a new CBD. This used to be the food terminal owned by the government. It was bought by Ayala a couple of years ago through a bidding. But prices here have escalated. They bought the land for about 30,000 pesos per square meter. The commercial properties here are now selling at about 170,000 pesos per square meter. So what is interesting here is that this would really take advantage of the development in Makati and Fort Bonifacio, which are now experiencing decline in available land, developable land. So apart from that, they will have the South Integrated Transit System, which is basically the terminal for provincial buses. So that will create captive demand for retail, for office, and as well as housing here. So they will also have BPO buildings as well. It's about 7 kilometers south of Makati. This is one of the first condos that is being sold. The veranda, it's about 62 square meters on average, selling at 215,000. Yeah. And then another hotspot. So apart from Makati and Fort Bonifacio, we think that the next CBD that will emerge would be the Manila Bay Reclamation Area, specifically what is called Asiana City. So this is where the new casino district is being built. So if you've heard about the Soler or City of Dreams or Resorts World Bayshore, so this is where it's going to be located. The casinos, unfortunately, are not doing well during the first half. Their revenues have declined, I think, because of the pinch that is being felt by China. So they're not getting as many Chinese gamers as they hoped. But we do hope that this will improve moving forward. So these are some of the projects that have been sold in this area. Monarch Park Suites, Windsor Suites, and Balmoral Suites being built by Anchor Land. From what we've heard, so there were 2 towers that were sold previously, and some of the buyers were Singaporeans that bought by block. So quite popular with the Singaporean market. So this is selling between 140 to 375,000 Singaporean dollars. And then another opportunity would be Kingsford Hotel. This is a condo hotel development. So it's where an investor would buy a room, but then that room would have to be put into the pool of the hotel, wherein they'll lease it out like a hotel, and then you would share with the revenues, the hotel revenues. So it is an attractive investment scheme. And it's done quite well in the certain areas such as Makati. This would sell at around 158,000 Singaporean dollars. Average room size would be around 24, so it's basically a hotel room with no kitchen facilities. Okay, another popular hotspot outside of Metro Manila would be Cebu. It's popular because it offers the same advantages such as a city. It's very cosmopolitan, but it's also close to the beaches. So Mactan Island is where you'd find resorts such as the Shangri-La, Movenpick, and Plantation Bay, as well as Crimson Resort. So very popular destination amongst regional travelers, the Chinese, the Koreans, Japanese, and so forth. Cebu is also growing because of its BPO base, so it's seen as a secondary location compared to Metro Manila. So Cebu, because it's cheaper in terms of labor as well as real estate costs, a lot of BPOs put up secondary facilities in Cebu. So one example of a resort type development would be One Manchester Place. This is in Mega World's development called Newtown. Selling at around 183,000 Singaporean dollars. Another would be Savoy Hotel. So this is also a condo hotel or a condotel, selling at 160 Singaporean dollars. 27 square meters on average. Okay, another hotspot would be Boracay. So I guess a lot of you know about Boracay. It's one of the it's recognized as one of the best beaches in the entire world by several magazines. So very popular both with locals as well as foreign tourists. And there has been some investment opportunities. So Mega World also has a development here called the New Coast. Um, it's actually on the, I think, the the eastern side of Boracay, and has golf course facilities. It also has a Savoy Hotel selling at 6.3 million pesos, or about 190,000 Singaporean dollars. So a very good investment. So overall, these are some of the hotspots that we have: Makati CBD, the Century City Picar Place development just outside the Makati CBD. Rockwell Center also remains very popular, very high end to the very high end market. Asiana City is where the Manila Bay Reclamation area is. So a lot of condos being developed in that area. And then outside of Metro Manila, you have Mactan New Town in Cebu, as well as the Boracay New Coast. So these are some of the hotspots that we have. Okay, so I mentioned earlier that there are now some challenges in investing in the Philippines. So one would be an ongoing threat of an asset bubble in the next few years. Although we do not see a pricing bubble, so prices have been stable relatively. So for example, the very high end prices have been increasing at around of 10%, but on average, overall market has only been increasing at around 6%. So I can't say that there are there's a bubble forming in terms of prices. What is a bit worrisome would be the supply. So there is a supply bubble that is coming up. As I mentioned here, the supply in the major CBDs will increase by roughly half in the next 4 years. So from about 63,000 units, it will jump to about more than 100,000 units. So it would be more challenging for investors in the major CBDs such as Makati, Fort Bonifacio, Ortigas, Alabang, moving forward just because of the supply. So the same rental growth and the same occupancy levels might not be enjoyed by these investors. Also, in general, about 170,000 units will be delivered in the entire Metro Manila area. So, but these are usually in the fringe, in the more affordable areas. And if you compare the sales levels in Makati, Fort Bonifacio, to the other areas, the sales take-up continues to be very attractive. Cebu also, we observed that in Cebu, there's going to be a big jump in available condo available condo stock from about 12,000 units to around 33,000. So we expect that rentals would be more challenging. Okay, so also if you're investing in the Philippines, I don't recommend that you have a flipping mindset because it's very difficult to do. You would probably, if you decide to sell immediately, like within a 2 or 3 year span, you would probably end up with the same amount that you invested because of the tax implication. So most likely the taxes that would be imposed on you would be capital gains tax, as well as some local business taxes and transfer taxes. So value-added tax would be imposed if you are a real estate entity, a real estate company domiciled in the Philippines. However, our capital gains tax is actually a transactions tax or a sales tax. It's 6% of the value of the transaction, regardless of what your initial investment was. So you don't calculate the difference between your initial investment and your sales price. So that would probably erase your gains during the first couple of years if you decide to flip. Also, with the amount of stock that's coming up, it would probably be more difficult to do since you're competing with a lot of different investors doing the same thing. So the Philippines would mainly be a buy and hold for the next 5 to 10 years strategy. Okay, another thing would be that you have to make sure that the property management company has a good track record. So a lot of these developments do not have very good property managers. They do not take care of their developments. And usually the developer scrimps on paying the property manager. And that's why the property usually suffers. So you have to take a good look at who will manage the property moving forward. So there are some developers that have their own property management companies, and they do a good job. So you have to carefully assess that. Also check if the buyers are absentee owners, so meaning that some of these developments have a lot of, like a big foreign buyer base or a big overseas Filipino buyer base. Some of these buyers do not fund the association dues. So it's very difficult for the property manager to have funds to continue to maintain the buildings properly. Okay, so despite all of those issues, what are the opportunities that remain? So the CBD locations, I feel, are still stable. The traffic situation in Metro Manila is terrible. Like 10 years ago, it would take me around 45 minutes to get to Makati. Now it takes me about an hour and a half to 2 hours commuting to work. So the situation, I think, will not be addressed because it's very difficult to install new roads in Metro Manila, despite all of the new infrastructure, the skyways that are being built. And also because of the low interest rate environment, it's easier for people to buy new cars. And that's actually one of our issues. Okay, so that will probably create demand for the condos that are located inside the CBDs. We've also already seen a trend wherein the workers are renting condo units in the CBDs so that they could stay there during the weekdays while they have work, and then they would just return home to the suburbs during the weekend. So it's an increasing trend. Also, if I am going to buy in the Metro Manila market, take a look at the secondary market because usually the prices are lower compared to the pre-selling market or the off-plan market. And you won't have to wait 3 to 5 years until the building is completed. You could already lease it out. So it has rental income already. However, you will have to put down 20% down payment upfront instead of it being amortized. The stretch payment terms that you could enjoy with a developer for a pre-selling project. Okay, so as I mentioned earlier, we expect the population to grow, and then a huge portion of it would enter the workforce. So that will continue to create demand for CBD locations. So we're entering into that demographic sweet spot. And the BPO industry will continue to increase the income levels of these employees, and they continue to increase their demand for office space. So later on, I'll talk about that as well. I mentioned earlier, condotel investments do seem to be a very good investment, but you also have to be choosy on the developer, whether or not they have a reputation in this kind of development. And then also, the provincial areas are growing. So where can you probably take a look? Davao, there's a lot of condo developments there. One is being branded as a Dusit, so it will be supported by the Dusit hotel chain. We do think that that will be successful. There are also developments in Iloilo, in the Visayas area, and also the Clark or Angeles City area in Pampanga, where the Clark Air Base used to be. So there's a lot of industrial manufacturing activity in that area, as well as BPO activity. So those continue to be very good investment alternatives. So as I mentioned earlier, what else can create opportunities for you? So this is actually the demand and supply for office space, and it's generally because of the BPO demand. So the light blue line would be for the new supply. So we're hitting all-time highs for new supply. But this, despite of these all-time highs in supply, we still think that occupancy levels will remain high. So we only project around 5 or 6% vacancy rate despite the influx of all these new office developments. And it's really because the BPO demand for office space seems to be insatiable. We've been presenting this slide, each year, where we find that it's going to be an all-time high, but the BPO market continues to get the space each year. So there would be opportunities for you to invest in office space as well. So the developers have noticed that potential, and there are several strata-titled offices that are now for sale in Fort Bonifacio, outside of Makati, and in Alabang, the Alabang CBD. So the typical investment would be for Fort Bonifacio would be around $584,000. In Makati Fringe, it's about $350,000. This is actually a medical office, and it's already sold out. But there are some that are now being launched in the Ayala project called Circuit Makati. And then Alabang, also an emerging CBD, 232,000. So if you think that the residential market is too risky, then maybe take a look at the office market, because this is more stable in our view. So I think this is my last slide. Thank you so much.